Dividend investors often ask more than just, how much did they pay? The smarter question is, what must PLDT spend to keep those dividends flowing? Examining the latest results provides insight into the complex balance between network investment, revenue growth, and shareholder rewards. PLDT's recent 52.1 billion pesos outlay on property and equipment, up 7% year-on-year, underscores their aggressive strategy. Almost 50 billion pesos in cash outflows for investing activities solidify network spending as the core of TEL's financial approach. These are not abstract numbers. They represent real investments designed to defend and expand PLDT's telecom footprint. On wireless, the story is all about mobile data and 5G expansion. Mobile data revenue reached 59 billion pesos, fueled by rising internet usage and expanding 5G adoption. Device partnerships and bundled offerings make next-gen connectivity more accessible, driving momentum. Fixed wireless broadband like home Wi-Fi isn't just a side note. It grew by 25%, highlighting new ways wireless meets household demand. Turning to fixed-line home broadband revenues rose to nearly 40 billion pesos, a testament to the persistent need for reliable connectivity. Most notably, enterprise revenue in ICT surged 21% as PLDT's focus shifts from legacy services to high-growth areas, data centers, managed IT, and data and AI solutions. These segments provide the counterweight to declining traditional voice and SMS, anchoring future growth. But every investment requires a trade-off. PLDT explicitly weighs dividends against capex, working capital, and debt servicing, determined to avoid sacrificing future connectivity for today's payouts. Yet, the reality is visible. Operating expenses climbed 4%, and depreciation, largely due to modernization, rose sharply, pressing on net income and potentially curbing future dividend comfort zones. Debt tightens the equation. With liabilities at 297.5 billion pesos and interest coverage trending down, financing costs are steadily claiming more of PLDT's cash flow. This isn't a crisis, but it is a constraint. Dividend growth depends on reversing these pressures or at least monetizing investments more efficiently. Fortunately, PLDT has cleared older vendor obligations and maintains robust momentum with fresh commitments. This signals disciplined spending rather than unchecked expansion. For dividend investors, the verdict is nuanced. Sustainability appears solid, provided operating cash flow remains strong and capex is focused. Dividend growth, however, will hinge on whether these investments translate into better customer retention, steadier revenue per user, and higher margins from enterprise ICT, without further straining balance sheet leverage. PLDT is investing to drive growth, but for dividends to climb, those investments must deliver results in cash flow and coverage. For now, cautious optimism is warranted. The story is far from finished, but the pieces are moving thoughtfully into place.